Ladies and gentlemen, good day and welcome to the Orient Bell Limited Q2 and H1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suyash Samant from Stellar IR Advisors. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us today. We have with us today the senior management of Orient Bell Limited, Mr. Aditya Gupta, Chief Executive Officer, and Mr. Anuj Arora, Chief Financial Officer, who will represent Orient Bell Limited on the call. The management will be sharing the key operating and financial highlights for the quarter and half-year ended September 30, 2025, followed by a question-and-answer session. This call may contain some of the forward-looking statements which are completely based upon the company's beliefs, opinions, and expectations as of today. These statements are not a guarantee of the company's future performance and involve unforeseen risks and uncertainties. The company also undertakes no obligation to update any forward-looking statement to reflect developments that occur after a statement is made. I now hand over the conference to Mr. Aditya Gupta. Thank you, and over to you, sir.
Thank you. Good evening, ladies and gentlemen, and welcome to our Q2 FY26 earnings call. In the building materials sector, cement and steel, which are the first stage of construction activity, have shown good signs of revival. This is a positive development which will have trickle-down effect on the tile sector. Tile exports are up 6% year-on-year versus 12-month FY25 average. And with no new capacity expected to be added, this should lead to a reduction in domestic market oversupply. We maintain, as per our previous commentary, that government projects, execution, gas costs, geopolitical environment, and tariff wars continue as decisive factors impacting demand across the building and construction industry. At Orient Bell, we are steadfast in our focus on our mission to make tile buying easier for the end consumer. Our AI-based visualization tool has been welcomed warmly by the dealers, cementing our pole position in using tech to deliver a superior buying experience. Continuing on our brand campaign, we have added TV ads in more regional languages like Bengali, in addition to Hindi and Kannada ads. Building brand recall will continue to be a focus area for us. On-ground engagement with influencers is scaling up. Continued focus on adding new products from our units and our trading partners has also helped in keeping up with changing customer demands. Learning and development remains a key focus at Orient Bell, aimed at empowering employees to embrace customer delight in sales process. The focus on customer experience and brand building continues to help drive vitrified mix in our total sales. Vitrified tiles now are at 58% of sales in H1 FY26, while GVT is about 41% in H1 FY26. This is now broadly similar to the industry. All these have helped us deliver revenue growth of 3% over last year, despite a soft market. Coupled with a very successful cost management, we have achieved a 250 basis point improvement over Q2 last year in our gross margins, taking it up to 39%. To summarize, our investments towards building a better product portfolio driven by higher brand awareness and unique digital tools, along with our historic strength on cost management, are showing us better results. With this, I would like to hand over to our CFO, Mr. Anuj Arora, to take the quarterly update forward. Thank you.
Thank you, Aditya. Good evening, ladies and gentlemen. So we continue to monitor the market closely. Encouragingly, we are beginning to see positive signs of recovery in both the cement and steel sector, which gives us optimism for a stronger performance in the second half of the year. Our sustained focus on operational efficiencies has resulted in a 3.7% reduction in manufacturing cost on a like-for-like basis, after adjusting for the impact of product mix and energy prices. Gross margins have improved both sequentially and year-on-year and remains among the best in the industry. On a consolidated basis, Q2 EBITDA stood at 9.8 crores, representing a 22.5% increase over the last year. PBT is at 3.9 crores, up from 80 lakhs last year. For H1, EBITDA was at 15.4 crores, a gain of 19% over last year, and PBT is at 3.3 crores, a strong turnaround from a loss of 1.2 crores last year. This effectively offset the losses incurred in Q1, marking a solid recovery in Q2. On the balance sheet side, despite a moderate increase in inventory to support sales, we have maintained a healthy working capital cycle of 26 days, consistent with March 25 levels, and an improvement of 7 days versus September 24. We have also initiated repayment of our long-term debt, and our net debt position remains comfortable at 3.6 crores. With robust cash balances, this underscores our strong balance sheet, healthy liquidity, and solid cash flow situation. With this, I'll request moderator to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question comes from the line of Manish Singh, who is an investor. Please go ahead.
Hello, am I audible?
Yes, sir. Please continue with your question.
Yeah, my name is Gunit Singh. I'm from Counter-Cyclical PMS. So, sir, if we look at our margins, operating margins, they have been around 3 to 4% for the last 2 financial years, whereas historically they have ranged between around 8 to 10%. And the last 2 financial years also coincidentally were years where real estate performed considerably well in its cycle. So, in your best judgment and from your experience, I mean, where do we see ourselves in the in this cycle? Because ours is a cyclical business. So, at what point do we see ourselves in the cycle, and by when, or do we see any signs of improvement in terms of, say, the market dynamics? And even if we look at in terms of total installed capacity as well as any plant shutdowns, so can you please give us an overview of the market in that sense as well?
Okay. So see, you're right. The listed tile companies in FY24, FY25 have not done well on top line growth, and which obviously put pressure on profitability. But we see some green shoots of improvement. I see informal checks tell us that significantly large number of units in Morbi have decided to close down permanently. And exports this year, as I said earlier, is averaging about 1,500 to 1,600 crores every month, which is about 5-6% more than what it was last financial year, 12 average. So this, along with the closure of some units in Morbi and no new significant capacity coming up in Morbi, means that now demand has a chance of catching up with supply, which for the last 2-3 years, supply has been consistently ahead of demand. With respect to our margins, we had 6% EBITDA margin this year. In our size of business, the operating leverage plays an extremely critical role. The good thing is that at almost 39% of gross margin, I think we would be somewhere near the best in the industry. And as we get our revenues growing faster with all the initiatives, I think you'll see some repair work on the EBITDA margin. Quarter 2 was better than quarter 1 clearly. And historically, you will find that H1 is weak. Actually, quarter 2 is better than quarter 1, quarter 3 is better than quarter 2, and quarter 4 is the best. So I see a positive, as far as Orient Bell is concerned, I see a positive trend.
All right. So, in terms of operational efficiency, what is the current capacity utilization on a consolidated level? And, I mean, by when or are you hopeful of any considerable volume growth this year? Or, looking at the current market scenario, does it give you any green shoots in terms of more uptick currently as compared to, say, last year or the previous 2 years? And by when can we ramp up to full utilization in your judgment? And also, if we look at the competitive intensity, so our margins have been subdued. If we talk about the operating margins, they have been subdued as compared to players like Kajari and Somany, which are operating around 15 to 20% operating margin, whereas ours is around 6 to 8%. So, is it such that we are not able to premiumize our products, or our products are more considered as commoditized?
You have asked me some 10 questions. You have asked me some 10 different questions, so it's very difficult to kind of pick and choose what to answer. The first thing is you need to correct your facts. One of the names that you took never had 14% EBITDA margin in my memory over the last 8 years. So I think you need to cross-check your figures of the other listed peers. That's number one. I've already answered your question on EBITDA margins, how they look. And so I really don't know what is the new question that you're kind of... okay, you asked me a question on capacity and all. We don't give out volume numbers, but our volume growth, our 3% growth in quarter 2 has been led by volume growth and not by growth in ASP. So that would give you a direction which the company is. Other question I think I've already answered. If you have a specific question, maybe you can just ask that question and I'll answer that, please.
Or it says join back the queue. Thank you.
Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants of the conference that if you wish to ask a question, you may press star and 1 on your touchtone phone to join the question queue. Our next question comes from the line of Ashwath, who's from Arihant Capital. Please go ahead.
Hello, and thank you for the opportunity. I have a few questions. One of them is, what is our gas cost blended for this quarter? If you could help me with that, sir.
Our blended cost, so Ashwath, our blended gas cost is similar to last quarter, is in the range of 44,
Slightly less. I think about 1 rupee per cubic meter less than what it was in quarter 4 last year. Something like that.
So I couldn't hear you. Was it 44?
Can you just... Sorry, I'll just take that.
Sir, there seems to be some disturbance from your line, from the management. Let me just quickly reconnect you to the call.
Is it better now?
No, sir, there still seems to be some disturbance. The participants will have trouble hearing your voice. Just a moment, sir. Participants, please stay on hold while we reconnect the management. Ladies and gentlemen, the management is connected again. Mr. Ashwath, we can continue with your question again now.
Yes, my question was on the gas cost. I couldn't really hear what the management said. Could you reiterate?
So, Ashwath, in this quarter, our average gas cost was around 43.3 per SCM, and it is in line with the previous quarter, which was 44.5. So slightly it has reduced.
Okay, sir. And could you help me with the project retail split? And also, if you could help me with what is our trajectory going forward? Do we expect some improvement on the project front?
You're talking about project retail split.
Yeah, split. For this quarter and
Ashwath, on the project retail split, we take, as always, projects which are of a volume of more than 3,000 square meters as a project. Everything else we count as retail consistently. So we have about an 80% to 80% of projects and 20% of retail. Sorry, the other way around, 80% of retail and 20% of projects. And we have been, the dependence on retail has been going up, the salience of retail has been going up, while projects have been a little lower compared to, say, about a year back.
Okay, sir. And on this aggressive front that we have started in this quarter, what are our views on this? How do we see this business panning out? The pilot project that we started. I know it's very in its nascent stage, but still, if you could just help us with what kind of capex are we doing or including?
So, Ashwath, you're talking about the adhesive business, right?
Yes, adhesive.
Okay. So we started this sometime in July end, so very early days yet on this. We are not envisaging any capex as of now. And the nature of the business is that you can effectively, cost effectively supply in, say, about a 350 kilometer kind of a radius. So we will keep on adding partners. And depending on how the business does, we look at a capex or own manufacturing next year. It's not a very big capex, but this is something which we are not considering in this financial year. The reason for getting into this business was that, with more and more vitrified ceramic tiles being replaced by vitrified tiles with larger size of tiles, there is a need for tile adhesives. What earlier was getting done with cement is no longer good enough. So this market is growing actually faster than the tile market.
Another question is, sir, on the utilization levels. If you could help us with that, and also specifically on our Dora plant, what are utilizations on? If you could quantify this.
Ashwath, the line is not very clear, so I think we're talking about utilization levels. So our utilization levels have improved when compared with quarter one. They've also improved compared with on a year-on-year basis. And Secunderabad, which is our mother plant, has done very well. The South Bay, South and Dora plant and Hoskote plant are a little low.
If you could help me with the percentage on each of these plants and also the blended.
So we have done about 68% capacity utilization for manufacturing in this quarter.
Okay, sir. And the industry is taking some protective measures when it comes to safeguarding their margins, especially some of our peers. How are we doing something in line with the industry to protect our margins? What are our measures to do the same? Just wanted to understand.
So, Ashwath, we have always had healthy gross margins. I think quarter two, our gross margin was about 39%, which in itself are significantly better than what they were in quarter two of FY25. And if you see the last 5-6 years, you will see that on gross margin, the company has always been in the top two or maximum top three of the companies. So for us, gross margins is not really a concern. We are good at that. We need to build up an operating leverage. We are extremely sensitive to that. And that is somewhere where our focus has been. And as I said in the last question, we have had growth this quarter has been a volume-led growth, not an ASP-led growth. And we intend to kind of continue with that.
Okay, sir. And one last question from my end is, what is our target for H2, top-line margins? And also, if you could help us with FY27, some numbers on the same.
So, Ashok, we don't give forward guidance. You know that. But as I said earlier, H2 for our industry and most of Orient Bell is always, in terms of both top line and margins, much better than H1. So,
Okay.
so I hope to continue with that trend.
Okay. Thank you, sir. I'll follow back to you.
Thank you, Ashok.
Thank you. Participants of the conference, a quick reminder that if you wish to ask a question, you may press star and 1 on your touchtone phone. Our next question comes from the line of Khush Mehta, who is an individual investor. Please go ahead.
Hello. Thank you for the opportunity, sir. So I had a couple of questions, but as recently Ashwat talked about the adhesive business segment, I'd like to have a little bit more information about that. Like, how are the margins in that segment in our adhesive business? Hello.
So Ashok, I think it's too early for us to give you a sense on margins. As I said, we have just started this at July end. And we just started with one plant, and the business is still in a few millions a month. But overall, the margins, the gross margins, I think will be attractive, but maybe a bit too soon. I think we'll be able to give you a clear picture by the end of quarter 3 on this. We are not, as I said earlier also, we are not incurring any capex. We are leveraging a lot of our existing manpower and other assets. So we hope to make a decent gross margin on this. But more about this in quarter 3 when we have at least 3-4 months of experience there, we can talk to you more about margins.
Okay. And so also on the similar line, as we have recently entered this market, but there have been other players who are already doing this. So if you would see from a price point of view and from a quality point of view, where do we stand? Are we at a premium or are we at a similar level? How is it? And in quality-wise as well?
Okay. So quality-wise, what we have done is we have taken, we have looked at the best products which are available in the country. And from a quality perspective, we have benchmarked ourselves to those products. And whatever qualitative tests and quality tests are there, our product either matches or does better than the industry leaders on this. So that's been our philosophy on quality. In terms of pricing, this industry again has a very large number of players. But what I can tell you is that we are priced at a premium to the other tile manufacturers who do adhesives. We are at a slight discount to the leaders in this industry, but compared to the tile companies, we are at a significant premium.
Okay. And also, we have, I guess, around 3 to 4 different types of adhesives that I've seen on the website. So are we planning to add further? Because on the website, it also mentioned that your R&D team has cracked this. So is there more products in the pipeline or anything like that?
Yes, we are now working on epoxy, and grout and all, which is something which we would launch in the coming months. So that whole range would slowly get completed.
Understood. Thank you for that. And also, sir, if we talk about our marketing expense, we have been doing TV advertisements and all, and we have been doing Instagram advertisement as well, and we have been actively working on the page. So, what's the response from the market? Have we started winning the market in the north and the west side? How do you look on this?
So, Kush, I think that has been a good story for us. I mentioned in response to I think Ashwath's question that our retail salience has been strengthening. It has been going up. And that is, I think, a lot of it is being driven by our increased visibility. We are not just advertising in Hindi. We are advertising in Q2. We are advertising in Kannada. We are advertising in Bengali. We have added 2 more languages in Q3. At 2 more states, we are doing language regional language ads. So this is something we are consistently working on. This is something we are consistently investing on to build brand awareness and brand recall. And the increase in retail salience is telling us that it's working.
Okay. And also, sir, we have been opening experience centers. That's one near my house in Pune as well. We just wanted to check, are we planning to add further or will we stick around 300, 310?
So we are adding new experience centers. Orient Bell Tile Boutiques is what we call them. But but a bigger priority this year is to strengthen the customer experience in our existing OBTVs. So we will not, the gross ads will not be as high as what they were last year.
Okay.
But we continue to keep at it.
Okay. Understood, sir. That's all from my side for now. Thank you so much.
Thank you, Kush.
Thank you. Ladies and gentlemen, a quick reminder that if you wish to ask a question, you may press star and 1 on your touchtone phone to join the question queue. Our next follow-up question comes from the line of Ashwath from Orient Capital. Please go ahead.
Yeah, thank you for taking my follow-up. Sir, the industry has taken some price hikes lately. We just wanted to understand on that front, do we have a similar view in taking price hikes?
For price hikes. So Ashwath, I also kind of read that about some competitors were talking about a 1.5% price increase in their costs. So we have taken a price increase in 1 or 2 products, not across the board. We have just, what we have chosen to do is be a bit more conservative on the discounts that we are giving out in projects and all. And we are leveraging all the data that we have. For us, everything is digitized, has been digitized for a few years now. So we are working very hard on using all that wealth of data to try to squeeze out, to try to reduce deposits from people who are not giving us volumes. So market facing, no price increase, but a lot of work is happening behind the scene, which is actually leading us to move in the same direction.
Okay, sir. So is it safe to assume, sir, for us, for the next few quarters, our numbers will be better based on volume growth and not primarily due to ASP?
I didn't get the second part. The first part you said about numbers in future, and the second part of the question which I did not get, please repeat that.
I asked, is it primarily the next few quarters, do we see numbers coming in from volume growth, or would it be a mix of better ASPs and volume growth?
More volume given than ASP. So we will continue on this strategy of pushing volumes higher. And ASP is more market driven, so let's see how it goes. But we are reasonably confident that the operating leverage as we drive volumes, we will get enough and more operating leverage, plus our cost cutting measures that are in place to ensure that our margins are healthy.
Okay. And sir, one of our previous calls, we had some foresight on expanding to tier 2, tier 3, and so on. So, any update on the same, and what is the outlook going forward?
See, this, the data is not very definitive on this. So we are kind of, tier 1 is about 23% odd in H1 for us, and tier 2 is about 18%, tier 3 is 59%. So we have distribution gaps that we are aware of, and so in terms of where the growth is going to come from, I think for us it is across the board. It's not very heavily. This is that we are kind of growing very fast in tier 3 and kind of just managing in tier 1. It's not like that. We have cities like Bombay and all where we are doing much better than what we have done in the past. So it's a bit of a mixed bag, Ashok.
Okay, sir. And on the dealers' inventory front, could you give us an update on what is happening on that?
So that continues. Dealers have reduced inventories. All the price competition day in and day out which is there, so dealers are not keeping too much stock. So this trend is there, and I think this trend is there to kind of stay.
You said, sir, again, could you repeat?
I'm saying this trend of the trend of dealers downstocking and rationalizing the stocks and all is very much there in the market, and I expect it to continue like that.
Okay. Thank you, sir. Thank you so much. That answers my questions. Okay.
Thank you. Our next question comes from the line of Tanmay Roy from LinkedIn. Please go ahead.
Hi, thank you for this opportunity. So, sir, I just most of the question being answered from my end, sir. I want to check that in the last peak cycle, which was in 2022, our margins were almost comparable with our peers, like 9-10% of EBIT. But from that, there is a gradual decrease to about now 4%, whereas the other competitors are able to maintain the margin near about 8-9%. So, was it because operation cost has gone up, or what could be the possible reason, and how do you see the improvement from here?
You're absolutely right. There has been a decline in the EBITDA margins compared to what they were in that, say, 4 years back period. I think there are multiple reasons for that. For example, gas cost in our model unit and even in our south plant of Viscote, where we have long-term tie-ups with gas authority, the gas cost there did not go down while a lot of our competitors, most of our competitors actually do bulk of manufacturing in Morbi. There with the mix of propane and LNG and much more
Hello?
Hello.
Sir, I could not hear
Hello.
anything in between. It was got cut completely.
So let me start again. See, there are multiple reasons why our margins have suffered. And one of them was that the gas cost in our Secunderabad and Hoskote plant was kind of higher. It went in the opposite direction compared to, say, Morbi. That was one contributory factor. The second factor was that we had our operating leverage did not kick in. Our top line has been at similar levels. We were at 700 crores in the year that you mentioned, and then last year we were 667 crores and all. So the top line made an impact. And of course, costs keep on increasing. And so these are some of the reasons that it has not done well. But the good thing is that through the years, our gross margins have continued to be very healthy. We have kept on making them, and now I see in this financial year, a lot of repair work which we had done there has started showing results. So we did 6% in quarter two. As I said, quarter three and quarter four are traditionally better in terms of top lines and bigger margins. So we are cautiously optimistic going forward now.
Okay. Okay. Fine, sir. So, just another one more question. So now that like 2022, that when we have, I'm from Bangalore, I've seen that the builders are already started giving all this, deliveries of their units. So anything which has been sold at 2022, so maybe coming for ready for moving to around 26, 27 time. So in this cycle, if our volume, goes up, and now our product mix is also at the higher end, like we have more battery tiles than the before. So can we expect some better margin in this cycle in case if the volume goes up?
Of course, that is the case. Even if you see the current quarter, with a 3% increase in revenue, we were able to add 1% to the EBITDA margin. So the operating leverage comes into play. So of course, with better revenue, this percentage, EBITDA percentage, will surely improve.
Okay. And do you see, sir, any demand from residential real estate side to be improving in the next financial year, like this financial year, second half onwards?
So I think, when we started this year, we all talked about that H1 is going to be challenging and H2 will be better. So we are still maintaining that. And definitely, I think when you talk about FY27, I think it will be a much better year simply because you see how cement and steel have done in quarter two versus quarter one, both on volumes and revenues. So this is the starting of a building, and as we come closer to the finishing, that is where the tile demand would also pick up. And as I talked about earlier also, we don't see any major capacity. See, one of the reasons for the margin suppression was also that from say 22 to 24, 25, there were units opening every day, every week in Morbi, and which led to a huge erosion in the selling price at the industry level. I think today the rate at which the industry is selling GVT versus what it was doing in 22, I would say maybe for Morbi they were to talk about, maybe they are selling it at 50-60% lower price. So all of that were responsible for this.
Okay. Thank you, sir. That was actually, I was just thinking like as cement demand as this quarter, we can see that many very good results they are showing, maybe tiles might follow. So thank you so much, sir, for answering all the questions.
Thank you.
You're welcome.
Our next question comes from the line of Shubham Padhiyar from RAS Capital. Please go ahead.
Yeah. Hi, am I audible?
Yes, Shivam.
Yeah. Sorry, sir, if this question got joined up little late.
Shubham sir, your voice is cracking. Could you please repeat your question?
Is it fine now?
Yes, sir.
Yeah. So I was saying, sorry if this is a repetitive question, but I joined a bit late. So I was just wondering what was the reason for the increase in gross margins by 250 bits? Hello?
So, Shubham, basically, what we have done is, if you're watching us, we have been continuously working on costs. So on a like-for-like basis, approximately 3.7% is that we have saved on our manufacturing cost. So this is the main contributor for the gross margin increase.
Okay, because this quarter we haven't seen any ASP increase, right? So, and we just had volume growth, so that's why I was wondering, I mean, 250 bits increase in gross margin is a bit higher.
So yes,
anyway,
this time, so basically,
Yeah.
again, everything is coming from the operational efficiency. In terms of ASP, it is similar to the quarter one, but whatever gain that has come is on account of volume gains.
Okay. So what do you, I mean, do you have any sort of expectation going forward in the year in terms of gross margin? I mean, do we see similar kind of gross margin going forward, or there might be some, relaxation?
No. So again, it all depends on how so basically gas is something which is not which is something variable. Considering the constant gas prices, we can expect similar margins.
Okay, understood. And what was our marketing spend for this quarter and for the like-to-like quarter last year?
I think we continue to invest in marketing. This quarter also, we have invested 3.8% in marketing. Last year also, it was around 3.7%.
Understood. Yeah, okay. That's it from my side. Thank you.
Thank you. Our next follow-up question comes from the line of Mr. Ashwath from Orient Capital. Please go ahead.
Thank you. Thank you for the follow-up. Just a few questions on the industry front. If you could, sir, help us with the export scenario right now in Morbi. And there are also some talks on some players focusing now on the domestic markets. So, is there any scare of additional volumes coming in for India? If you could just help us with a holistic approach on this.
So, Ashwath, as I said, the 5-month volume, 5-month revenue for the export, I think it is a BOB Capital report, is about says that this 5 months till August 12 data is available, is about 6% value growth over the last year monthly average. So that is one thing which is a good sign, because if you remember, FY25 was a steep decline to FY24. So we are still not reached FY24 levels, but a 6% growth is a good sign. That's one. A lot of units, Ashwath, in Morbi seem to have closed down permanently, which are units which were smaller units, which I realized that their cost of production is not really going to enable them to compete. So this is another positive sign. And third, I said earlier that no significant capacity is coming up in Modi in the next 6-8 months. So all of this put together, I think, will work towards reducing this dumping of stock at variable cost plus prices into the domestic market. So I see this as a positive. And as a positive for all the listed companies, all listed companies have hardly any export dependence. They're totally domestic, dependent on domestic market. Does that answer your question?
Yes, sir. Okay. Thank you, sir. Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Aditya Gupta for closing comments.
So thank you everybody for being there and for your interest in Orient Bell. I look forward to meeting you guys again 3 months from now. Thank you.
On behalf of Orient Bell Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.